Hello investors, I'm Stuart Cruz and welcome to Cruz Asset Management's update on the market. We're through the first half. The year has flown by already. We're mid-July and we're having review meetings and all of my clients are asking me what's next. The market is down roughly 20%. The S&P is down 20% through June 30th. The international market's also down more than 20%. The Qs are down almost 30. That's tech heavy, biotech heavy index. Bonds are even down 10 or 11%. That's supposed to be your flight to safety. So there were really no asset classes that could help protect your portfolio. So what's coming next? Well, it depends a little bit on about your time frame. So the math says that anytime the market's been down 20 to 30%, 3 years out, of the last 10 times, 90% of those times the market has been up and been up significantly on an average of around 9% a year. So that bodes well. That said, in the short term, 3 to 6 months, we still feel like there's going to be weakness. Why is that? Well, everybody's hoping and waiting for the Fed to thread the needle or give us a soft landing. But that's just something the Fed is just not good at. And we shouldn't expect them to be good at because they're looking at data that really is 3 or 6 months old and they're trying to project 6 to 9 months into the future. And the idea of doing that is really, you're just hoping for luck to really work out. In my opinion, that needle that they're trying to thread, the hole in the needle that they're trying to thread is not existing. That needle is really just a steel bar and you're pushing thread against it, hoping that that thread's going to go through. I don't think there's space for the Fed to orchestrate or engineer a soft landing. Now, why do I say that? Well, let's go to some charts here. We'll just take a look at it because first, let's paint this picture. Inflation just printed at 9.1%, a new 40-year high. People were expecting after that 8.6% inflation print for it to start drifting back down to the 7s and 6s. Instead, we went the other direction. Why? I think because the Fed is behind the curve. There's no other way for them, no other place for them to be. They were late raising interest rates. They raised them pretty aggressively, 75 basis points at the last meeting, but they are still behind, and we'll talk about that. And in order for them to reduce inflation, they need, because unemployment is extremely low, so you're having wage pressure there, they need to basically cause a recession so that the economy slows down. So they are in a no-win situation. Either they are stuck with inflation and maybe stagflation because we've had negative GDP growth, or they raise interest rates too high, cause a recession, which drops interest rates. And some people are expecting them to drop interest rates after the economy slows down. Now, this happened in the 70s and 80s until Volcker stepped in, because what basically happened was they would raise interest rates to combat inflation, and then it looked like the market was tanking and the economy was settling down, so they would drop interest rates, but then that would cause more inflation. And they kept playing this game for more than a decade until Volcker stepped in and just said, we're just going to raise interest rates and drive inflation down. So now Powell said he is a student of Volcker, but he really hasn't stepped up to Volcker's history, if you will. So all he's done is, as a matter of fact, his rhetoric was in last meeting that he wasn't even going to raise 75 basis points at all. That wasn't even on the table. Now, he's since reversed that, but at the same time, he's certainly not going out of his way to catch up to the yield curve. So let's talk about that. What do I mean by being behind the yield curve? So we're going to go to the Friends at Y charts. We have the 2-year Treasury rate here on the map, or up on the chart. And this is what we've seen. Saw a long period where the 2-year was extremely low, interest rates jumped up, and again, we had a period where interest rates were basically at zero. Okay? So let's put the Fed funds rate on top of this chart. And the 2-year Treasury rate is in purple, the Fed funds rate is in orange. You can see the overnight rate, how closely it mirrors this 2-year Treasury rate. But where we're at right now, there's a big gap. There's about 175 basis point gap between the 2-year and the Fed funds rate. So that means that the Fed has an accommodative position. Accommodation spurs more inflation. Now, they're trying to combat inflation by raising interest rates, but they need to close this gap down. Not only that, They have a big balance sheet. They are trying to reduce the buying and actually sell off the balance sheet, but it probably will end up just allowing it to mature to some extent. But we're trying to unwind the accommodation position of the Fed, and they're still accommodative. So this accommodation helps with inflation. I mean, it doesn't help our inflation, it actually increases inflation. So I'm going to also put, why do we seem like we're having a trouble figuring out what to do? Well, here's the 10-year on top of the 2-year. Now the 10-year, you can imagine if you're going to lend the government money for 2 years, you're going to get one interest rate, and you would expect if you lend them for 10 years, you would get a higher rate. But that's not what we see right now. Right now, the 2-year is at 3.23 and the 10-year is at 3.01. That means you actually get paid less money to lend the federal government money for 10 years versus 2 years. So that means the yield curve is inverted. Now I'm going to add the 2 10-year spread onto this, and we're going to take a look at this yield curve. So here is the spread between the 2 and 10-year. So now keep in mind, this is the 0 line. Whenever the 10-year is above or below the 2-year, this goes below the 0 line, so the yield curve is inverted. Who cares? Well, honestly, we should care. So I'm going to show you where the recessions are over the last 10 years or so, or this is the last, 40 years. Now let's see if we can notice a little pattern here. So here's the 0 line where the yield curve gets inverted. So anytime the purple line is below this 0 line, that's an inversion of the yield curve. And then this gray line means we went into recession. So we're above, 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 go below, recession. Above, 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 go below, recession. Below, recession. Now we touched it here, we had a small recession, and now we're inverted again. And people are asking themselves, are we going to go into recession? Well, the 3 things that generally precede a recession are an inverted yield curve, check. Fed tightening, we know that's happening, check. And energy prices increasing. Well, here's a price of U.S. crude year to date, and it's up 46%. Check. So all 3 things that generally precede a recession have already taken place. And we're really questioning whether there will be a recession or not. I think it's a foregone conclusion. We're already in a recession, which is what we said in the last video update. So we feel like the economy is going to slow down. What really hasn't happened yet is energy hasn't fully turned over. So you can imagine if the economy goes into a recession, then manufacturing companies are going to be using less energy, which creates less demand. With less demand, reduces prices. So the hot area of the market, commodities and energy, are looking like they're starting to roll over, but they haven't done so yet. And that's something that will have to happen if and when we do go into this recession. So what does that mean for your portfolio? Well, we're remaining to stay defensive. There is no asset class, or very few, I shouldn't say no, I'm sure we'll point to something, that is really in favor right now. So here's the SPY. If we look at a 10-year chart where each one of these candlesticks is a month, this is on a clear negative downward momentum. And I'm just going to run through some asset classes here. Here are small caps. That is clearly negative. And we at Cruise Asset Management in January started reducing our exposure. Here is international, clearly negative. Emerging markets, bonds, got crushed. That's supposed to be your safe haven. That's down 20% from its peak, down 11% year to date. Junk bonds, not doing any better. We're looking for gold, which is supposed to be a flight to safety. Gold is supposed to be an inflation hedge. It traded in a channel, broke out, formed a flag pattern, broke out of here. So I thought, hey, we're going to be off to the races with gold. We actually went long for a little while. And then this also broke down. So gold is not helping your portfolio either. Really not a whole lot of areas out there. You can look at, here's a commodity price. So commodities have done very well, but that looks like that's breaking down a little bit. Topped out here on the stochastic, and it looks like the MACD is about to turn negative. Hasn't broken down yet, but looks to be so. Real estate, not doing any better. These inflation hedging asset classes like energy, commodities, inflation, real estate, that inflate with inflation look like they're pricing in a recession that's going to come. So that's real estate. XLE is the energy ETF, and that looks like it's about to turn over. So there doesn't seem to be really any place in the market to hide. So we've reduced and we're staying reduced exposure in equities across the board, mostly fixed income. We're dabbling in a few areas of real estate, like this particular, some real estate has done well. Some areas of commodities have done well. Very few countries are in favor right now. So at the end of the day, we're biding our time and waiting for the signals, right? So that's what we're doing with our portfolio in the mid-year review. We think this weakness will continue. So right now, if I look at the S&P 500, yeah, we've had a good month. July has actually been positive. But in any kind of these upward trends, you see red along the way. This is a clear upward trend, and we've had several months, sometimes even a quarter that's down. And now we've had a lot of red and a little bit of green. So this green doesn't really break the trend. It's still a longer term trend. Oh, and I'll point out one more thing. Here we're looking at this chart. This red line that I drew here is kind of an eyeballed regression of the appreciation and price march up of the S&P 500 over 8 years. And spent some of the time above it, some of the time below it, but in general, stayed pretty close to that line. So it's been on a nice trajectory. And then COVID hits. The Fed added $6 trillion of economic stimulus to the economy. And then the market took a decided different angle on the upside. And here it traded in a channel right there, and it broke that channel. And what I could argue is this red line is really the natural line that this economy should be on, or that the S&P should be on. But we're still above the red line. If we look at, let's say, PE ratios in the S&P 500, we were trading at, let's say, 22 forward PE, and now we're down to about a 16. Now, long-term average is around a 15 or 16. I could argue that with a rising interest rate, that PE, the long-term average, should be a little bit lower than what we've seen when interest rates were basically at zero. So, but even so, let's just assume that the long-term average is at 15. We're at 16, so we're still above fair value. Earnings have not been adjusted down yet. We haven't really seen a lot of companies come out with bad earnings, so that's actually kind of bullish. But we think that earnings are going to get adjusted down. So if you have a PE ratio and the E drops, then that increases the PE. So that means the market is still arguably expensive. Generally, we don't see the market go from expensive and hit fair value and stop. So I'm not expecting it to hit this red line and stop and go, okay, we're good now. Normally, momentum takes things through the red line, or sentiment will take it through the red line. So I'm anticipating a further decline through this red line, through the PE of long-term averages of 15 and 16, so that we get more into the cheap realm. So that means that we could still have some downturn. So in the next 3 to 6 months, I'm anticipating some more downturns in equities. If we're looking at 3 to 5 years, like, hey, I'm going to put money to work and I'm leaving, I'm going to the moon, and I'm not looking at the market and I'm not going to mess with anything, probably the market will be up 3 to 5 years from now. So if you're talking about putting money to work in a structured product that's 3 or 5 years out, that might be an awesome investment. But for the short term, we're staying on the sidelines, we're staying defensive, and we're waiting for the signals. All right, thanks for watching. My name is Stuart Cruz. It's Cruz Asset Management with our 2022 mid-year market outlook update.